Alrighty, so welcome back to video 3. If you want to, pause this video, and if you have the handout, which if you're in my classes, you'd have the handout. If you're watching from afar, then you can just work this together with us. So hopefully you've created your pension worksheet here in Excel. You sort of know what you're doing, so we can go through. Now again, take a moment, pause the video, fill out the components of the actual benefits. So the PBO, the 5 things there, the 4 things in the plan assets. Remember, one does overlap with PBO benefits, and then the last 2 things in pension expense that's not there. So see if you can do it from memory. See what goes into your pension worksheet. I'm going to cheat a little bit, but y'all pause and do that. All right, so hopefully you paused that video and you figured out these. Again, without looking at your notes, the 5 things that go in the PBO: service cost, interest, any prior service cost adjustments, actual gains or losses on PBO, and benefits paid. Then that benefits paid overlaps, so then the plan assets would be benefits paid, expected return on plan assets, actual return there on plan assets, and contributions. And then for your your pension expense includes the service cost, the interest, the expected return. Then the last 2 items you need to fill into your worksheet: your amortization of PSC and your amortization of the gains and losses. Okay, so that's all the components there of our pension expense. Now, let's do 2019. But before we really get started on 2019, remember we need to plug in our lovely beginning balances. Now, this is a building problem. So 2019, the beginning balances will come from the 2018. So hopefully you've already watched video 2. If not, go back and watch video 2, because that's going to give you all your beginning balances here to pull in. Well, where do we start? Well, remember, our pension, we ended with that 1,100 underfunded position, which means our PBO here was that 2,780 that we found. Our plan assets is 1,100 less than that because we're underfunded, so that would give us the 1,680. Okay, and that's again 1,100 less than the 2,780 there. What other beginning balances do we know? Well, let's go down here. We can say our beginning balances and our accumulated OCI. I like to put them down here. It's a little easier to see. We ended with not 495, sorry, 440 there. And again, that just goes right back up here. Notice when we ended our year, we ended with, why did I put 440? 495, that's correct. Sorry, I was right the first time. That's what I get for double guessing myself, 495. And then we go up here and we had the 191. That's a credit position, because that is a net gain that we're carrying. So I'm going to put a credit there of 191. And then again, we started with the negative 1,100. Now we're going to find the changes right here so that we can find our ending balances in all of our accounts. So let's go up to the top. Start with PBO just like before. We're going to sort of sail through this one really quickly. So 2019, let's find our information on our handout. Here's the information provided in 2019. Service costs of 600. Well, that's the first piece we need for our obligation here. So we said, hey, when we have service cost, our PBO goes up. That actually creates a greater amount because plan asset 0 minus 600 gives us negative 600 change there. And then the offset is going to be our pension expense. Okay, so debit to pension expense, a credit to the PBO. We're in balance. Now, again, let's double check to make sure we don't have any prior service adjustments before we do the interest. So let's go see. Here, no changes in actuarial assumptions or estimates. That's awesome. And nor do we have any additional PBO. Sometimes you do, sometimes you don't. But in this problem, we have 0 here. That's great. That means there's no change there. And that means there's absolutely no additional PSC. So the only balance we have to worry about is still that 495 that we carried forward, that 55 a year we have to amortize. So now that we know we have no prior costs, we don't have to worry about it as part of our interest calculations. So for interest, we can literally take the 2,780 times our discount rate for 2019 is 10%, so 278 in interest obligation. Again, that's going to further cause us to be underfunded. And then interest is also part, so we need to debit our our pension expense, not our interest expense, our pension expense for 278. I know we're going a little quick because we did all this really in detail in 2018. So I'm trying to go through it a little quicker in 2019 so we can get done. Actuarial gains or losses. It tells us there are no changes in assumption or estimates. So therefore, that is also 0 this time. 0. And this would impact here, so 0. So no impact for that change. And then benefits paid. Now, typically, if you have any retirees, benefits have been paid. So let's find it. Service cost discount, payments to retirees in 2019. There we go, 480. Well, when we make a payment, our obligation goes down, so that's 480 less than we have to pay our employees. But we pay them out of plan benefits, so we need to credit our plan assets, debit our obligation, and we have no change over here. So it's a 0. We don't have to worry about any other benefits paid. That's the only place it impacts. It impacts PBO and plan assets. All right. We've got all 5 components of our obligation. We can now find the ending balance in our PBO. So our change there, if we take the 600 plus the 278 minus the 480, that tells me that we're increasing our obligation by 398. That is a credit position. If we start at 2780, we add 398 to this account. We're going to end with a balance of 3178, and that is a credit balance. So that 398 there is a credit to the PBO. We've now found our PBO. Let's move to the second component, and that's our plan assets. Our plan assets are debits. We started with 16. We already know we're crediting that for 480 because we've paid out of the account to pay our retirees. That's step 1. Now let's talk about the expected return on our plan assets. What did we think we were going to make? So let's go find that. Read through our information again. We should see an expected long-term rate of return on assets again in 2019 is going to be our 12%. So how do we get that? Well, we're going to take 1680. So pull out your calculators. It's important to always have a calculator when we're doing this stuff. And we're going to take the 1680. We're going to multiply that by a lovely 12%. And for the first time, we're getting a decimal. So that's 201.6 there. Okay. Now that's going to be an increase. Why is it an increase? Well, anytime we get a return, it's going to increase our assets. Just like the example I gave last time where you have that interest accruing on your savings account, it pulls your balance up. Okay. Now we need to compare that to the actual return. So we know for a fact, so let's find our actual return. We already know for a fact our expected. Our actual return was 170. Again, we're not doing too good here. So we had 170 in actual return. We subtract that from the 201.6. That means we need to reduce it, obviously. So 201.6 netted with the 170 says we had too much gain of 31.6. So we need to back down our assets by 31.6. You're like, well, why don't we combine those and just do one? Because they impact different things. Remember, when we do the expected return, that actually reduces what we think our pension expense is for. Okay. And then that I'll say here would be a debit to our plan assets. When we don't make that much, it goes in and it reduces us. It doesn't help offset the full. So remember, I can't offset my underfunded by 201. I have to offset it by a net of 170, the actual return. But that gets amortized there. So it's going to go here with our gains or losses. Okay. So we want to make sure that we don't net those two. We want to show the 201 is true. The 31.6 goes here. The actual return and the actual gains and losses are amortized. So those two will be amortized as part of this. We don't automatically go against the pension expense. Okay. All right. The cool thing is this is way in the future. This is all projected, so we're good. Now, the last thing we need to look at for plan assets are our contributions. Contributions for the year 2019, it tells us they added 620. That helps us a lot. So we're going to increase that by 620, which means we're going to help offset some of that underfunded status there. Now, where else does that go? Well, over here, we got to remember when we do that, we have to take it out of our general cash and put it over into our set plan assets, our actual pension plan. All right, very good. Now we've got our components of the plan assets, all 4 of those. So if we add them, 480, 201, 31, and 620, We net those, you end up with 310. That is a debit. We're increasing that balance. So 1680 plus the 310 gives us a lovely and wonderful, what is it, 1990? I think that's 1990. We add those together. Yep, 1990. Perfect. And that is, again, a debit balance because those are assets. Okay? Very good. Let's finish this out strong. We need two more numbers. We need the amortization of the PSC and the amortization of the gains or losses. Now, PSC, let's start there. It's the easiest. We have no mention of PSC in here, but did we have prior service costs? Yes, we did. We had the $495 carried over, so that was the $550, remember, over 10 years. What did we say in 2018? Well, we have to amortize it at 10 years or $55 per year for the next 10 years. Same rule applies here, so we're going to go in and we're going to say, hey, we need to reduce that balance by 55. When we do that, that actually increases our expense. We're allocating that into that year, that 55, 1/10 of it into that year. Okay. All right. No other changes across the board. So then let's talk about the amortization of the gain or loss. Doesn't mention it, like, oh, well, then I don't have to worry about it. Not true. Do we have a balance? Yes, we do. We had a beginning balance of 191 that we pulled from last year. All right. So we're going to go down here. We're going to do negative 191. Corridor test is always needed to find amortization of GL unless the problem just tells you what it is. Most of the time it won't. So 10% or larger of the PBO. So let's go up here. Which is larger? The 1680 in planned assets or the 2780 in PBO? Well, the 2780. So 10% of that is 278. So we're going to go down here and say, hey, 278. Now, well, actually, you don't even have to put the negative. That doesn't matter. Just put a positive there because you always compare the two. Doesn't matter that that's negative. Okay. So the 191, 278. 191 does not exceed 278. Whether positive or negative doesn't matter. So that means how much are we allowed to amortize? Absolutely nothing. Now, I know there's a difference there, but the net gain or loss in accumulated OCI has to be greater than the 10% mark before we get to amortize any of it. So since the 191, it is a gain position, but since the 191 is less than the 278, there is nothing that we have to amortize at this point. So our balance there is not getting too large. We're okay. So we do not have to amortize any. So it doesn't matter that the service life is 10 years because 0 divided by anything tells us we do absolutely nothing. So that's what the importance of that corridor test is. But this year we know we don't have enough. So that's a 0 and a 0. So we don't have to do any amortization this year. Awesome. So let's come up with our entry. So to do that, I'm just going to get rid of that. And we're going to pull this screen in right there, nice and neat. All right. So we have our pension. We're going to add the 600, the 278, the minus 2016, and the 55. So that tells me I'm going to have a net of 431.40. And again, that's pension expense. It's positive, so therefore it's going to be a debit to that account. Cash, negative 620. Cash is a credit account, or a debit account, excuse me. So we are crediting the account because we're taking it down by 620. Prior service cost, that would be a debit balance. We need to remove it, so we're going to credit that. We're reducing that balance, so we're going to credit it by 55. Gains or losses, we had no amortization. We had no actuarial gains or losses, so 31.6. Okay, that's actually going to be a debit there. It's going to offset the gain because we made less than we thought we did, so that's going to be a debit. It's going to reduce that prior service gain that we had. All right, add up this. So we do start here. Don't add the beginning balances in. We don't want the beginnings added to find our journal. That would be double counting. So we're going to simply add the 600, the 271, the 201, the 31, and the 620. Of course, net them. You don't just all add them together there. And that actually comes out to 88. That is going to be a net credit position because, notice, we're going to credit the PBO for $88 more than the plan assets. We're not actually going to journal that. We're going to credit the $398 here, and we're going to debit the plan assets. The net of these two will give us that 88 impact. Okay, very good. So before we do our entry, let's just find our balances to carry forward. We had 495, we're reducing by 55, we're going to carry forward 440 into the future. So our PSC going into next year, 2020, will be a 440, and again, that is a debit balance because that PSC is an expense. Okay, it's just being deferred. So we would credit it and debit the expense when we need to. Our net gain position is going down further. So now instead of having a gain or a credit balance in that account of 191, we're going to have a net gain position of 159.4. We'll carry that forward. So that's 159 as a net gain. So that's going to be a net credit. And then last we had 1100. We're increasing that. So now we're not underfunded by 1100. We're underfunded by 1188. So we're underfunded in that account even further. And that's detailed. See, 3178 minus 1990 gives us that 1188 underfunded. So our pension plan at this point in time is way underfunded. And again, all these numbers are in millions, so way underfunded. All right. So what does that leave us in accumulated OCI for our comprehensive income balances here? 280.6. And of course, that is a net debit position. Okay, not that we would report it that way, but that just sort of tells us what the final balance is. All right, we got all this wonderful information. Now we can do our journal entry. Don't overthink it. If you can just remember the components of each, you can complete this worksheet. Okay, and that tells us what our entry is. So let's split this screen. We've got our lovely components here. So we're going to do our entry. So let's go down here below the 2018 and let's do 2019. So what are we going to do for 2019? Well, we can record pension expense. I'm just going to hit pension expense. I'm going to hit that again. Let me fix my formatting. I should have done this before the video. Sorry about that. Our pension expense, we're going to go in and hit it for 731.4. What else do we need to do? Well, on top of our pension expense, I need to credit cash, so I'm going to wait on that. I need to credit the amortization here, so I'm going to wait on that. Here, we actually have a debit of 31, so I'm actually going to increase my loss position on the OCI. It's not amortization, it's actually increasing the loss position of 31.6. That's the reason anything above here we actually treat differently. We're going to always journal the amortization separate from any changes in the gain or loss account above, okay? Very important that we do keep those separate. All right, what else do we have to debit? Well, going across, we need to credit that. We need to debit the plan assets. So I'm going to go in and hit my plan assets. I'm going to debit them for 310. All right. I think that takes care of my debits. Let's go with my credits. What credits do I have? Well, we see a big credit to our cash of 620 for those contributions we made. We do have some amortization of our prior service costs, so we're going to do amortization of our prior service costs. And again, that's part of OCI. We're going to hit that for a lovely 55, just like before. Anything else? Well, credit, all the way over here, we got that PBO we need to credit. PBO, we're going to credit here for, and again, PBO is projected benefit obligation. I just like to abbreviate because it's quicker and easier and we know what we're talking about. So 398. So if we've done everything correctly, if you again add these three, you should come up to the sum there. Your equation or your equation balances, yes, but your journal entry, your debit and your credit balances. So that's just I think the easiest way to come up with our pension entry is to create a little pension worksheet that we can jot down, find the components of the PBO, the plan assets, and the pension expense. If you can define all of those components, remember, these 5 goes into our PBO. The next 4 that we label goes into our plan assets. And then service cost, interest, expected, and then these last 2 go into pension expense. If you can define and find all of those items, you can easily come up with your journal entry. All right, so I hope these videos have helped sort of clarify how to find information, how to figure out the amount for the entry, and actually record the journal entry for a defined benefit pension plan.